Good morning. It's Wednesday, April 9th, 2025. Zach Howard. Here's your morning market update. Thoughts to start the day. First up, U.S. Treasury market, the biggest, most liquid market in the world next to the currency market. We are seeing stress build in that U.S. 30-year bond. The longer the duration of a bond, the more sensitive it is to rises and falling interest rates. As yields rise, the value, the price of that bond decreases. We are seeing that 30-year bond move close to 5%. Nice round number, but we're seeing the rate of change move 50 basis points here since Friday. U.S. Treasury bonds should not move like that unless something is happening underneath the surface. Is that China or a big player who holds treasuries are loading? Is this prime brokers calling in leverage in the stock market with hedge funds? We're going to continue to see how that plays out, but that is going to build stress in other parts of the market. Second up, Canada. Oh, Canada. I woke up to $56 oil here this morning. Listen, Canada makes not very much outside our natural resources. Our biggest asset is our oil. And we get a lot of revenue, a lot of jobs, and a lot of the economy depends on oil. If we have $56 oil, what does that mean? It means the government, red, blue, green, it doesn't matter who's in charge. Pick your favorite team, whoever's your politician. They are going to spend way more money. How does governments get money? Two ways. They tax you or they borrow. If they have to borrow and there's not enough people or funds globally to buy the Canadian bonds, the Bank of Canada steps in. They buy the bonds for the federal government to support deficit spending. That is called quantitative easing. They've already initiated that program back in January. $56 oil means they're going to have to spend more money, send out more social programs to people to prop up the economy. That's going to debase the currency. It's going to make things like real estate, gold, hard assets more valuable in fiat money terms. Which leads me to my third thing, gold miners. Gold miners. First up, central banks own gold. They don't own gold miners, and they continue to accumulate gold at a record pace. Gold miners are a much higher beta version of gold, but if we step back from the volatility of markets for a second and just look at the underlying business of gold miners right now, we've seen their largest output, their product they sell, go up 30%. We've seen their largest input, fuel costs, go down 30%. What does that do to free cash flow? Goes through the roof. So when do gold miners get a re-rating because of the future value of all their future cash flows? That's how you value a business. Yes, there's going to be volatility in equity markets, but if you're looking to buy good businesses that have massive profitability in the next couple of years, gold miners fit the bill. I'm Zach Howard. I'll see you tomorrow. Have a great day.